Money is not just earned, it is understood. Welcome to MWH tutorial where accounting, economics, and finance are made simple. Still on our series of solving past question from WAEC, and we're still looking at this recent 2026 paper. Number 8. Question number 8. Question number 8. The question is about ratio analysis or financial ratio. Ratio are simply numbers used to judge the performance of a business. They are simply numbers used to judge the performance of a business. Think of it like a medical checkup. When you go for a medical checkup, both of you and the doctors, you are not interested in the number, but you are willing to know whether you are healthy or not. The same thing with financial ratio. To check the performance of a business, whether the business is healthy or not. So from the question here on the board, the following were extracted from the book of Toby Limited. Trading profit and loss account for the year ended 31st December 2022. For debit side, here are the information on your screen. For the credit side also. Then the balance sheet as at 31st December 2022. Here are the information also. The question says you are required to calculate rate of stock turnover, gross profit margin, current ratio, asset test ratio, return on capital employed. These are the 5 ratios we are expected to calculate. One ratio, rate of stock turnover. We are going to calculate rate of stock turnover. Rate of stock turnover. Rate of stock turnover. This ratio tells us how inventory are being replaced, how quick inventory are being replaced. For instance, when you have the goods in your provision store that stays for almost a year, this is bad for the business. But when you replace them every month, this is a good to the business, or every day, this is good to the business. So it tells us how quick inventory are being replaced. So the formula for this is costs of goods sold over average stock. This is the formula. Cost of goods sold over average stock. I know you might ask me, what is average stock? Average stock, average stock, average stock is equivalent to opening stock plus closing stock all over 2. This is a formula for average stock. This is average stock. This is a formula. So now, let's substitute the number and see what we are going to get for the rate of stock turnover in this particular question. So where is our cost of goods sold? See our cost of goods sold here in the question. You are trading profit and loss account. Cost of goods sold 227,700. Here, cost of goods sold 227,700. This is your cost of goods sold. All our average stock. Let's calculate our average stock here. Opening stock. Our opening stock. Let me do it here. Opening stock. Our opening stock is 63,000 plus our closing stock. Our closing stock is 50,300 divided by 2. Divided by 2. You have the answer is 113,300. 113,300. This amount divided by 2. Divided by 2. Therefore, your answer should be 56,650. 56,650. This is our average stock. So we are going to bring it here. This is our average stock. 56,650. 56,650. So now our rate of stock turnover, this amount 227,700 divided by 56,650 is going to give us 4.02, approximately 4.02, what you are going to say times. This tells us that our stock is being replaced 4 times in a year. 4 times in a year. This is what this figure is telling us. Our stock is being replaced 4 times in a year. The next one is gross profit margin. Number 2. Gross profit margin. Gross profit margin. The formula for this is gross profit over net sale times 100. Times 100. Gross profits over net sales times 100. So our sales is here 418,350. 418,350. Our sales 418,350. All over. Gross profit. Where is our gross profit? Is here in our trading profit and loss. Is here as 190,000, 190,000, 650. 650. 650 times 100 times 100. Your answer will be 45.6%. 45. Your answer will be 45.6%. This is to tell you, for every 100 sales, 100% sales, business keeps 45.6 of profit before paying for any expenses. The next one is current ratio. This means it tries to measure whether the business can pay its debt or not. Whether the business can pay its debt. It has the ability, the ability to pay its debt based on its financial position to see if it can pay its debt or not. Here is the formula. Current ratio number 3. current ratio is equivalent to current assets, current assets over current liability, current liability is to 1. Always put this is to 1. This one represents the liability side, and what we are going to calculate will represent the asset side. So we check the question, where is our current asset and where is our current liabilities. Current asset, you remember our current asset involved stock, data, cash. Stock, data, cash. So the summation of current asset is 1,000, 101, 101, 150. The summation for our current asset and the summation for our current liabilities is 41,750. 41,750 is to 1. Okay, let's put it out when we get the answer. 750. Our answer will be 2.42 is to 1. 2.42 is to 1. So this is telling you this 2.42 represent the asset, 1 represent the liability. That is to say, for every one liability, the business has 2.42 assets to compensate for that liability. So therefore, the business is good to go. The next ratio is acid test ratio. Number 4. Acid test. Acid test ratio is very simple. It's just for you to remove inventory from this formula, because we are talking about how easily the asset can be converted to cash. And remember, sometimes stock might take time before you convert it to cash, unlike data or cash or bank. So therefore, we are just to remove inventory. Number 4, you can say current assets, current asset minus inventory, closing stock. Let's say closing stock minus closing stock all over current liability. So therefore, the answer will be this amount: 101, 150 minus our closing stock. Our closing stock is 50,300. All our current liabilities, 41,750. 41,750. Our answer will be 1.22. This is to tell you, even without selling inventory, company or the business can pay its debt. So the last but not the least is number 5, return on capital employed. Return on capital employed, also known as return ROS. Return on capital employed is also known as ROS. So the formula for this return capital employed Measures how efficient business uses its capital to generate profits. How efficient business uses its capital to generate profits. Here is the formula. Net profit over capital employed. Net profit over capital employed. We have our net profit here. Our net profit is 40,000. Net profit here 40,000. All our capital employed. Capital employed is equals total asset minus current liabilities. Capital employed. Let me put the formula for capital employed here. Capital employed is equals to total assets minus current liability. Current liabilities minus current liabilities. So what is our total assets? Check the right hand side of your balance sheet. Our total asset is 170,850. But our net profit is 40,000. Net profit is 40,000. ROC because our net profit is 40,000. Our capital employed, we are going to see our total asset is 170,850 minus our current liabilities. Our current liabilities is 41,700, 41,750, 41,750. Therefore, our answer 40,000, 40,000 all over. You want to 170,000 minus 170,850 minus 41,750. We are going to have 129,100, 129,100 and times 100. Let's see, 40,000 divided by 129,100 times 100. We are going to have our answer should be 31 point 31.8 cents. This is our return on capital employed. So that's all for the question. If you found this lesson helpful, kindly like the video, subscribe to the channel, and drop your comments.